My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people are my friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Only on Wall Street could you get a spectacular set of employment numbers, and the only thing anyone's worried about is recession. Even though the averages rebounded today from their lows, Dow gaining 140 points, the S&P advancing 0.34%, NASDAQ actually inching up 0.29%, this market feels like crazy town. As seemingly every single analyst vies to see who can be the most negative. I hate it. Things just aren't that bad. But there's nothing totally nutty about the negativity. I mean, I get it. Look, I mean, you have to understand, Wall Street's right to worry about a recession. It's on everybody's mind. Why? Because analysts and money managers don't care about the rearview mirror, even when it's something that happened this very morning at 8:30, like the Labor Department's terrific non-farm payrolls report. It was terrific. The professionals only care about the future. And from their perspective, positive economic news right now, it is terrible economic news tomorrow. Remember, we're sinners in the hands of an angry Federal Reserve right now. If we'd gotten a weak labor report, then Fed Chief Jay Powell could be less ruthless about hitting the brakes on the economy to kill inflation now. To portfolio managers, a strong labor report means the rate hikes will have to be even more aggressive. They see that as very negative. I get that too. And that's how you end up with this good news is bad news environment. But there's less the truth. It's actually more of a product of some rigor, of less than rigorous kind of a zeitgeist. See, Wall Street's tendency is for binary thinking. Either things are amazing or they're awful. No middle ground. It's not just the labor report. This week was all about many things that haven't happened yet. Slower auto purchases, lighter phone sales, a collapse in home buying, the end of the PC. Now, I do believe that our economy is headed for a slowdown. That's just what rate hikes do. But a slowdown doesn't necessarily translate into a horrific crash landing recession. As someone who's been addicted to black and white thinking my whole life, regardless of pharmacology, I know that's the wrong approach. There are many ways the situation can play out that don't end in a full-blown recession, and I kind of want people to consider that too. So how did this become such a grudge match between agony and ecstasy? It's all thanks to something I am loath to dignify, which is the relationship between the yields on the shorter-term 2-year Treasury and the longer-term 10-year Treasury. When the 10-year crosses below the 2-year, the fabled inverted yield curve, which is what happened this week, tons of money managers believe we're headed for a recession no matter what. This is the inverted yield curve, people. Why does anyone care? Because it's predictive. You'll hear people say it's predicted 6 of the last 6 recessions. That's a pretty good tool. But the truth is more complicated. In reality, it's predicted 12 of the last 6 recessions. As a signal, I would call it too sensitive. It will call every recession we have and many more that we don't have. Of course, we forget that anything like that when this comes up. Yes, it's an incredible twist on the Johnny Mercer classic. Wall Street feels compelled to accentuate the negative, eliminate the positive, and don't mess with Mr. In-Between. So everything positive is interpreted as either the last good number, the coda to a boom, or the arbinger of a depression because of the inverted yield curve. So what does that mean for next week's game plan? I wanted to set that up because I think it's a week where this is really all that's going to be discussed. Monday morning, we get the durable goods number. This is terrific, okay? This is exactly how it's set up. Because if it's strong, I can tell you it'll be pronounced as the last good number of a dying cycle because of how the Fed has to work even faster. If it's bad, it will be the first bad number of the apocalypse. The only thing that would save the durable goods discussion from going off the rails is news out of Ukraine that the Russians have backed down and gone home or something Putin seems totally reluctant to do, given the limited life expectancy of dictators who lose wars. It drives me nuts that our government doesn't seem to recognize that Ukraine's got Putin on the ropes. By some estimates, Russia's got a 20% casualty rate, which is catastrophic for a modern army. Remember, we only 10-11% on D-Day or Battle of the Bulge. If we give the Ukrainians some real offensive weapons, they can swiftly win this war, something that would prevent a global famine and dramatically lower the price of oil. It's a humanitarian crisis, but if the war ends soon, there's less of a chance for worldwide famine. Putting the war aside, we see the same absurd good news, bad news situation with individual companies. On Tuesday, we hear from an outfit you probably don't know. It's called Acuity Brands, big lighting company, outdoor, indoor, commercial, residential, you name it. Now, given its supremacy in the sector, we often look at Acuity as a tell for the broader real estate industry. Makes sense. Last time they did well, but thanks to the inverted yield curve, this time, if they say things are good, they'll be branded as hopeless optimists on their conference call unless they tell a truly depressing story. They can't win. On Wednesday, we get results from Greenbrier, which is just red hot because it supplies equipment to the rails. But you know what happened today? It looked like things went off the rails for the rails. I bet we'll hear the same last good quarter rhetoric here. But in this case, it might actually, it could be true. But right now, a ton of people are worried about plummeting freight rates. And we have to talk about this for a second. I did enough work on this today to know that the plummeting freight rates are true. They're falling like a stone. They're down some 30 to 35% as truck drivers return to the workforce. I don't want to brand this news per se, because lots of companies are in the trucking business, but the trucking spot market, which is the definitely an arbinger of what's about to occur, is in free fall. 30 to 35% just in 1 month's time? I don't think it's customer demand sinking, but supply of drivers rising, which is great for all companies that ship things, especially retailers and packaged good companies. But I will be branded as too optimistic, and people will say it's because there's not enough demand. That is not true according to my work, but it's what people will say. So let's look at that look at this through a prism of what I just told you. 2 o'clock, the Fed releases its minutes from the last meeting, and there'll be plenty of speculation about whether they'll go 25 or go 50, meaning 25 or 50 basis points in the next rate hike. Here's what you need to know. Those notes come from a period before the collapse in transportation rates, and that's something that can reduce inflation all its own. And Powell's got to be mindful of that so he doesn't overdo what he's trying to do to slow down the economy. So be mindful that they're old, all right? After the close, we hear from Chip Bergh, CEO of Levi Strauss, the consistent apparel company that can tell us whether the skyrocketing cotton costs, cotton, has hurt his gross margins like we've seen for so many other players in the industry. We know jeans have been hot. Has that changed too? We're finding out. Thursday's a cacophony of food and drink. When we get results from Constellation Brands, think Modelo and Corona, and ConAgra, think Slim Jims and Healthy Choice. Candidly, I just like that juxtaposition. I saw a terrific analyst report this morning that talks about how the stock of Molson Coors, which I like, has outperformed the group, but that outperformance is soon going to pass the Constellation. Makes sense. You never want to get in the way of a Mexican beer truck on Cinco de Mayo, a traditional sold-out day, by the way, at Bar San Miguel, the small Mexican place I started in Brooklyn almost a dozen years ago. And don't forget our CNBC Investing Club meeting. Now, this is very important. I do want you to join. Look, just join for this meeting. It's so much fun. We're covering all the stocks in our charitable trust, answering your questions. Of course, giving you a little bit of a worldview at the top. It's 12:30 p.m. at cnbc.com/investing club. It's incredible. Even so many of the people who hate me from GameStop have decided to sign up. Who knew? Friday doesn't have much except, again, we'll most likely be fretting about the pending slowdown. We do have an oil rig count number from Baker Hughes. I know the president wants the oil companies to drill more on the parcels of land that they own, the federal ones, not to mention opening up the already drilled wells that are currently shut in if they could. Don't bet on it, though. The oils are arguably the last remaining strong group besides the recession-proof utilities, and they love that they can make a ton of money holding down production. The bottom line, regardless of what happens next week, Wall Street's going to remain in good news, bad news mode. When other people start talking about the freight rate collapse that I'm talking about, you're never going to hear it because there's so many more drivers. You're only going to hear it because there's not enough demand. So perhaps you should steel yourself for the negativity. John in South Carolina. John.
Hey, Jim. Booyah from sunny South Carolina.
Oh, man, what great barbecue you have in South Carolina.
Yes,
I love it.
we do. Absolutely. Thanks for taking my call.
Of course.
I'm a long-term viewer of your show. I really appreciate your financial advice and guidance.
Thank you.
Jim, we're thinking of taking a position in a financial company. We've kind of picked out J.P. Morgan Chase, and I appreciate your comments relative to best-in-class capital appreciation and dividend security?
Well, look, J.P. Morgan does indeed have the fortress balance sheet. Jamie Dimon's there. It's got a 3% yield. But I will tell you, my charitable trust vastly prefers both Wells Fargo when it comes to being a broad bank, and then Morgan Stanley for that great yield and for terrific asset management. I think that both of those are ones you should consider, and I will talk about them at the CNBC Investing Club event, because those are two big positions for my charitable trust, which is giving out more than $570,000 this year. Now, regardless of what next week brings, I think Wall Street will remain in good news bad news mode. I need you to brace yourself for negativity. On Mad Money tonight, Blue Owl provides capital solutions to the private market. But can the stock provide gains for your portfolio? I've got exclusive with a very interesting SPAC company. Then the dream for many is to own a sports team. But what if you could own a piece of the action? I'm revealing 5 sports teams or leagues that you can invest in. And we're headed into proxy season. I'm learning more about that fintech player Broadridge. It's giving you a voice that you want to use. So stay with Cramer.
Miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.